For a long time, we believed that getting a good job and receiving a fixed salary every month would be enough to guarantee a peaceful life. You work hard, dedicate yourself, follow schedules, and at the end of the month, the payment lands in your account. It seems fair, right? But in practice, almost always this happens. No matter how much your salary increases, your bills also increase. Prices go up, responsibilities grow, unexpected events happen, and the money never seems to keep pace with life. This is the point where many people get frustrated. The feeling of working the whole month, anxiously waiting for the paycheck, and seeing it disappear in a few days is more common than you think. The problem is not just how much you earn, but the fact that you depend on a single source of income. When you live exclusively on your salary, any unforeseen event, a dismissal, a health problem, or even an unexpected expense can completely shake your financial balance. That's why today, more than ever, it's essential to understand the concept of multiple income streams. It's not about working non-stop, piling up jobs. It's about creating different ways for money to come in. This could be a small business, a service you offer in your spare time, a well-made investment that starts to pay off. The important thing is not to put all your eggs in one basket. When you build other ways to earn money, you also gain more security and freedom. Your lifestyle doesn't depend on the paycheck at the end of the month, and gradually you realize that the key is not earning more from your salary, but creating more ways for money to flow to you. Now that you understand that depending only on your salary is risky, let's talk about another problem that surprises many people. Spending everything that comes in. It may not seem like it, but this happens in a subtle and silent way. Think with me. You start earning a salary. With that amount, you adjust your life, pay rent, do groceries, cover basic expenses, and have a little left over. Suddenly, you get a raise or an extra job. The natural thing would be to save or invest that difference, right? But what happens to most people is exactly the opposite. They feel that now they can improve their lives, and they start to raise their standard of living. They change cars, move to a bigger house, travel more, buy more things. And so, even earning more, they still don't have anything left at the end of the month. This is called lifestyle inflation. The money increases, but the spending increases along with it. And the result is a dangerous cycle. You work more, earn more, but never see the money left over. The truth is that to build a solid financial life, you need to spend less than you earn, no matter how big your salary is. If you don't control this, it doesn't matter if you earn $3,000 or $30,000, you'll keep struggling. The secret lies in the discipline of maintaining a balanced lifestyle. It doesn't mean living tight or depriving yourself of everything. It means understanding what is a priority, what truly brings value to you, and what is just an impulsive expenditure. When you start spending with awareness, there's money left over to invest, to build your emergency fund, and most importantly, to build your future. The control is not in how much you earn. It's in how much you can keep without letting the spending scale with the increase in income. By now, you've noticed two important truths. You can't depend on just one salary, and you can't spend everything that comes in. Now it's time to talk about something that separates those with financial peace from those living paycheck to paycheck, the emergency fund. Let's be direct. Unexpected events happen, and they don't give a warning. It could be a health issue, a car breakdown, an unexpected layoff, or even a family emergency that requires a last-minute trip. If you don't have money saved for these moments, what happens? Most people end up resorting to credit cards, overdrafts, or loans, and get stuck in a cycle of debt that is hard to break. The emergency fund is your shield against this. It's that money saved, set aside, that you don't touch unless it's for truly urgent situations. But how much should you save? Experts recommend having at least 3 to 6 months of living expenses saved. For example, if all your monthly expenses, rent, food, bills, transportation, etc., total $2,000 a month, ideally, you should have between $6,000 and $12,000 saved in this fund. How to build this fund? You don't need to gather it all at once. The important thing is to start. Set a monthly amount that fits your budget. It could be $100, $200, or $300 per month, and keep accumulating it. The emergency fund money should be kept in a low-risk, high-liquidity place, meaning it should be easy to withdraw when needed, but not lose value over time. Savings accounts or short-term fixed-income investments are good options, and here's a golden tip. Don't mix your emergency fund with your savings for other goals, like trips or future purchases. This money has a clear purpose: to give you security when life surprises you. When you have a well-established emergency fund, you sleep more peacefully, because you know that no matter what happens, you won't have to scramble for last-minute solutions and jeopardize your financial future. Now, let's talk about something that weighs on the pockets of many people: debt. If you're in debt, with credit cards, overdrafts, or personal loans, you know what it means to be stuck in this cycle. The problem is not only the amount you owe, but the sky-high interest rates these types of debt carry. For example, imagine you have a $2,000 debt on your credit card and the interest rate is 10% per month. This means that the next month your debt will be $2,200 and the following month it will go up to $2,120. Soon enough, the debt grows much faster than the amount you originally owed. This is the vicious cycle that traps many people, making them pay for years without seeing the end of the debt. That's why the first step to achieving financial freedom is eliminating these debts. And for that, you need a clear plan. It's no good just trying to pay the minimum on your credit card every month, because the interest will keep working against you. Here's the strategy. Pay off the debts with the highest interest rates first. If you have multiple debts, start by paying the one with the highest interest rate, usually credit card debts or overdrafts. This way, you'll reduce the interest burden, which is the real villain. A practical tip is to use the Snowball Technique. Here's how it works. You pay off the smallest debt first and then use that money to pay off the next, always in the order of the smallest debts. This will give you a sense of achievement and you'll be motivated to keep going. Also, if you have the opportunity to refinance the debt or transfer the balance to a card with lower interest rates, take advantage of it. These options can significantly reduce the interest you pay. By eliminating debts, you'll free up your money. This means that what you earn can be used for other things like investments, building your emergency fund, or even realizing your dreams. Getting rid of debt is one of the biggest victories you can achieve on the path to financial freedom. Now that you understand the importance of not spending everything you earn, having an emergency fund, and eliminating debts, let's move on to the next crucial step: multiplying your income. This goes beyond what you receive from your salary. The more income streams you have, the more you are protecting your financial future. The reality is that many times a single salary is not enough to achieve your goals. Whether it's for traveling, buying your dream home, or even ensuring your children's education, relying on a single income stream can be risky. The good news is that in the digital age, creating extra income sources has never been more accessible. Passive income streams. First, let's talk about passive income. It's the key to making your money work for you. One of the simplest ways to create passive income is through investments. By investing in assets such as stocks, real estate funds, or fixed income securities, you start to make money without needing to work directly for it. The secret here is to start investing in an intelligent and consistent way. For example, if you invest $10,000 in a real estate fund that pays a return of 0.5% per month, Every month you will receive $50 back without doing anything. Now imagine if instead of spending that money, you reinvest those $50 every month. Over time, this amount will grow and generate a real passive income stream. The more you invest, the larger your passive income will be. Freelancing and services. Another way to generate extra income is by offering freelancing or services that you can do in your free time. This can be something related to your main job, like consulting in the area where you are specialized, or even something you are good at and enjoy doing, like photography, graphic design, content writing, or translation. For example, if you work as a graphic designer and can complete 2 small projects per month, charging $300 per project, that already generates $600 extra in your budget. And this amount can be even higher depending on the demand for services and your experience. The key is to use your skills creatively to earn extra money in your free time, whether at night or on weekends. Small businesses. If you are looking for something more independent and with greater growth potential, starting a small business can be an excellent option. Nowadays, it is no longer necessary to have a large initial investment to get started. You can sell products or services online, either through a store on Etsy, Mercado Libre, or even on social networks like Instagram and Facebook. The key to success in a small business is finding something you enjoy doing and that has demand. For example, if you love cooking, you could start selling homemade food or personalized sweets for events and parties. Or if you have a talent for crafts, you could create and sell unique products. The important thing is to understand what people need and be willing to offer it creatively and professionally. The power of the internet. One of the most powerful ways to create extra income is through the internet. With the popularization of platforms like YouTube, Instagram, TikTok, and blogging, many people are turning their hobbies into profitable businesses. If you have a passion for a specific subject, you can create content about it and, over time, monetize your audience. For example, imagine you love gardening. You could create a YouTube channel where you share tips, tutorials, and tricks on how to care for plants. Over time, your audience starts to grow, and you can generate revenue through ads, sponsorships, or even by selling your own products like gardening kits. The beauty of the internet is that it provides a platform for people from all areas of knowledge, from cooking to personal finance, to create their extra income sources. The key here is persistence and planning. Diversification is key. The biggest mistake you can make is relying on a single source of extra income. When you diversify your income sources, whether through investments, freelancing, or small businesses, you not only increase your chances of achieving financial freedom, but also protect yourself from unforeseen events. If one source of income decreases, you will still have others to sustain your lifestyle and continue progressing. Now you have some practical ideas to multiply your income, whether by creating passive income, offering services, or exploring online opportunities. The important thing is to start as soon as possible. The more you work to diversify your income sources, the closer you will be to reaching your financial goals. Now that you have extra income sources and have learned to control your spending, the next step is to make your money work for you. This means that in addition to simply earning more money, you should invest so that it grows over time, without you having to put in much effort. Why invest? Many people think they don't have enough money to invest, but the truth is that anyone can start investing even with small amounts. The secret is to start early and be patient. If you have $1,000 to invest and it earns 6% per year, after 12 months, you will have $1,060. It may seem little, but over time, that amount will grow more and more, thanks to the power of compound interest. The magic of compound interest makes money, once invested, continue to grow on its own, and the longer it stays invested, the more it grows. How to start investing. Now you might ask yourself, how do I start investing? If you are just getting started, fixed income is a good option. Investing in fixed income means you lend your money to the government or companies, and in return, you receive a fixed return. That is, a set amount that you will earn at the end of a period. Examples of fixed income investments include Treasury, direct or CDBs, bank deposit certificates. These investments are considered safer because the return is predictable, which is great for someone just starting out in the investment world. However, as you gain experience, you can begin exploring other options, like stocks and investment funds. Stocks are shares in companies that you can buy. When the company grows, the value of its shares grows as well, and you can sell them for a profit. However, they come with a higher risk because the value of stocks can go up or down unpredictably. Investment funds are a way to pool money from several people to invest in different types of assets, like stocks, real estate, and even other investments. These funds can be riskier, but they also have the potential to generate a higher return. Investing smartly. The secret to investing smartly is diversification. This means not putting all your money into one type of investment. When you diversify your investments, you spread the risk. For example, if you invest in fixed income, stocks, and real estate funds, your money will be spread across different types of assets, which reduces the impact of any one of them falling. Diversification is an important step to protect your money and increase your chances of good results over time. Investing is an ongoing process, and it's important to keep learning about what you're doing. Start with the basics, but always try to go deeper and look for new opportunities. Continuous financial education is what will make the difference in the long run. Remember, the sooner you start, the greater the potential for growth in your money. With patience, knowledge, and discipline, you can build a solid foundation for your financial future. Financial education. Continuous financial education is one of the most important pillars for anyone who wants to achieve financial freedom. Simply understanding how money works can be the key to making smarter decisions, both in the short and long term. The world of finance is dynamic, with new investment opportunities and market changes all the time. Those who have the habit of constantly learning not only protect themselves from risks, but also take advantage of the best opportunities that arise. It's like always being one step ahead, ready for any change. Someone who invests in their financial knowledge becomes able to adapt to market changes without losing control. Knowing how to choose between different types of investments, understanding the economic impacts and how inflation affects purchasing power are skills that only improve with time and ongoing learning. Financial education is more than investing. Additionally, financial education is not just about learning to invest, it's about understanding how to manage your money efficiently. Those who educate themselves financially know how to negotiate, plan for the future, and take advantage of opportunities in an intelligent way. This helps to create a mindset more focused on results and less on impulsive spending. The secret is to have the desire to evolve always, no matter how much you already know. The most successful people in finance never stop learning, and this habit is what makes them more and more prepared to handle the ups and downs of financial life.